Let's start off with Africa. I think it's quite interesting to note that when you look at the earnings in dollar terms, they were relatively flat. We know that you have had, of course, a bit of an issue when it comes to the foreign exchange rates, and of course how it translates into US dollars and rand terms. Tell us about African operations at this point in time and how you see those faring going forward.
Well, when we talk about Africa, we're talking about the rest of Africa, excluding South Africa. Yeah. We have been investing on the continent, as we've said on numerous occasions. We've been building branches in Nigeria. We've got a startup bank, essentially, in Angola. And then we have a portfolio of much more mature businesses. And in the results announcement today, we showed the different earnings coming out of our different banks for the first time. And I think it demonstrates clearly that if you have a fully fledged commercial bank, retail bank, corporate bank, you tend to earn good returns. When you're in the startup phases, the returns tend not to be so good. So as we've been investing in these, over the last 6 months, we've definitely, hurt the earnings. But it's a deliberate strategy because it'll provide us with good growth in the years to come.
Well, you're talking about fully fledged banks, and when you are operating as such, then obviously that will be reflected within the profit lines. What is your aim here? Are you aiming to be a retail bank, to be a fully fledged bank on the African continent, or do you think that you're predominantly going to be focusing on the corporate side of things?
Well, our experience has been that as you start building, you first have to put in place a corporate bank. You have to be able to have a trading room, deal in in securities and government bonds and all these things, and then service the major corporates, then smaller businesses, and finally what you get to is, call it, your SMEs and personal customers. And we found that to be a good recipe. At the moment, we're still making almost all our money in the corporate and investment banking side of the business. In fact, the branch network and the PBB business on the rest of the continent ran at a small loss, but that was part of a deliberate strategy.
Also fascinating to note, we know that you've got quite an important strategy when it comes to focusing on Africa. We know that you've sold off assets in Russia and, of course, Argentina as well. Tell us about what kind of profit lines and targets you've put in place when it comes to the African continent.
Well, we are much more focused on looking at our businesses in the context of corporate investment banking and personal and business banking, rather than country by country, because obviously these different franchises do tend to complement one another. But I would really think that off the current profitability of our African franchise, we should be able to double that in a relatively short space of time. We really feel that we've got, we're off a relatively low base. We've been investing a lot in infrastructure, and so we would really hope that we will see significant growth coming out of our African operations over the coming 2 to 3 years.
With regards to the cost-to-income ratio, we know that it came in for the first half at 58.4. Last year in the first half, we saw it at 58.1%. What is an ideal level for you? Is it closer to 50%? And if that is the level that you're targeting, when can we expect a move closer to 50%?
Well, actually, for the full year last year, we were north of 60% as well. Yeah. So we are, making some headway. And for us to be sitting at these levels is a relatively new experience, because, as you say, we were quite close to the 50% mark in the good times. Having said that, I'm not sure that we'll ever get back to quite those levels. And I've never been a believer that one should set absolute targets for the cost-income ratio. You should try and grow your revenues faster than costs, and that will result in a reduction in the ratio, which we've, of course, seen a reversal of in the last couple of years. So our focus is much more on the balance between the two rather than an absolute level of the cost-income ratio.
Let's touch on the cash that you're sitting on right now. I alluded to the fact that you have, of course, offloaded some of your assets in Russia and, of course, in Argentina. Where to from here? What can we expect from the cash front, and are you going to be putting that money to work soon?
Yes, those two transactions should result in a cash flow of $750 million, which will only happen towards the end of this year and in the early part of next year, respectively. So it's not as if the money is currently burning a hole in our pockets. Yeah. We don't have the cash yet. but they are completed transactions subject to various approvals and so forth. Our intention is very much to look if there are opportunities on the African continent for us to short-circuit our organic build and to see if in some of the countries we can perhaps acquire further operations. You may be aware that we relatively recently appointed the previous head of corporate investment banking, Rob Leith, to spearhead this initiative for us. So we are very much focused on seeing if there might be some opportunities on the continent for us. But as we all know, acquisitions are, they don't come along every day of the week, and you've got to be patient. So, but that would be our hope and intention.
Any possibility that you could be looking at any bailed out banks in Nigeria?
I think a lot of time has passed since the Nigerian banking crisis, and we did express some interest in certain assets. That looks increasingly, less likely at this stage. So I think that more likely, if one was able to do something in Nigeria, it would be a transaction involving a healthy bank. But we keep our eyes open for all situations, because you shouldn't be too rigid in your approach.
I'm going to ask two questions at one time because I know we're running out of time. Bank assurance, we know that you've really gotten this strategy right relative to the other players in the industry. We know that Standard Bank contributes around 33% of new businesses and sales, and 20% for Stanlib with regards to Liberty. Tell us very quickly about that. What gives you your competitive edge, and also dividend cover and dividend yield? Any changes on that soon?
Look, the relationship with Liberty works very well. We have a shareholding in Liberty, and that stands on its own, and Liberty, as we all know, has recovered well from its previous problems that it had a year or two ago. Insofar as selling product through the bank channels to customers, which ends up on the Liberty balance sheet, I think we have got that right, although we still feel there's a lot of room for improvement there. And it's just because of sheer commitment, and part of that is because of the shareholding that we have in Liberty, but sheer commitment to ensure that the bank assurance arrangements work. So it works well for both parties. In regard to dividends and dividend cover, we dropped our dividend cover during the bad times to about 1.9. We held the dividend. We didn't cut the dividend in the bad times, so we looked after shareholders then. Now that earnings are going up, we have to rebuild the dividend cover. Exactly how much we have to rebuild it by, I'm not sure. But my view is that we should just maintain the dividend at these levels for the time being, as the cover increases from last year's levels of 1.9 times cover.